Stay with me for a few minutes and don't let the title fool you into thinking this is just another China problem. Because what's building right now is far bigger, far quieter, and far closer to Western markets than most people are prepared for. Somewhere beneath China's skyscrapers, empty apartments, local governments, and state-owned banks sits an estimated $8 trillion debt bubble. And the most dangerous part isn't the size of the debt, it's how deeply the rest of the world is connected to it without even realizing it. This story doesn't start with panic, it starts with confidence. For years, China grew at a speed that looked almost impossible. Cities rose overnight, infrastructure expanded endlessly, property prices climbed without fear, and debt became the fuel that powered it all. Borrowing wasn't seen as a risk, it was seen as a tool. Local governments borrowed to grow, developers borrowed to build, banks lent because growth looked guaranteed. And as long as prices kept rising, the system looked stable. But bubbles don't pop when things look bad. They pop when everyone believes nothing can go wrong. The property sector became the heart of this machine. Apartments weren't just homes. They were savings accounts, investments, and retirement plans for millions of Chinese families. Developers borrowed aggressively, banks lent freely, and local governments depended on land sales to survive. The entire system fed itself. Then, slowly at first, cracks appeared. Sales slowed. Projects stalled, developers couldn't pay back loans, some defaulted, others were quietly rescued. But debt doesn't disappear just because you stop talking about it. It piles up. Today, China's local governments, property developers, and shadow banking system are sitting on mountains of obligations that can't be easily paid, rolled over, or written off without consequences. And here's the mistake most people make. They assume this is contained within China. It's not. Western markets are tied to China through trade, supply chains, commodities, investments, and financial sentiment. When China slows, demand drops. When demand drops, global companies miss earnings. When earnings miss expectations, markets react. This is how contagion works in the modern world, not through direct collapse, but through chains of dependency. Think about how many Western companies rely on Chinese consumers, Chinese factories, or Chinese construction demand. From luxury brands to chip makers to mining companies, China is baked into their forecasts. If China's debt bubble deflates slowly, growth weakens and markets feel pressure. But if it cracks suddenly, confidence evaporates, and confidence is everything in financial markets. Let me ask you something right here, because this is the turning point most people ignore. If an economy this large starts deleveraging under stress, where does all that lost growth go? And who absorbs the shock? The answer is uncomfortable. Emerging markets wobble, global banks tighten lending, investors rush to safety. Western markets don't crash because China collapses overnight. They crash because uncertainty explodes. And uncertainty is poison for markets built on leverage, expectations, and future growth. Now here's where it gets even more dangerous. China can't simply print its way out of this without consequences. Stimulus risks weakening the currency. Bailouts create moral hazard. Letting failures happen risks social instability. Pension funds, asset managers, multinational corporations, and global banks all have exposure, direct or indirect. Even if you've never invested in China, you're exposed through market sentiment, currency movements, and global growth assumptions. This is the human side of the story. When markets shake, ordinary people feel it through retirement accounts, job security, and rising costs. Big debt numbers sound abstract, but their consequences are personal. History shows us something very clear. Debt crises don't announce themselves politely. They arrive when confidence finally breaks. The real danger isn't that China's economy slows, it's that the world has built expectations on China growing forever. When those expectations reset, markets everywhere must reprice reality. And repricing is never gentle. So the real question isn't whether China's debt bubble exists. It does. The real question is whether it deflates slowly under control or whether one unexpected trigger turns stress into panic. And if that happens, will Western markets be ready? Or will they be caught assuming distance equals safety? If this video made you rethink how connected the global financial system really is, then you already understand why these stories matter before they hit headlines. Subscribe to the channel, because we break down the risks building beneath the surface while there's still time to see them coming. And trust me, China's debt problem won't stay a China only story for long.